Hey everybody, this is Sean Overton with OneStepRemove.com, and today I'm talking with Batur Asmozoglu.
That's good.
All right, yeah, I was worried about butchering that. Not exactly a common name, but Batur is Turkish, and I'm here in Istanbul. I've been working with him for the past month, and I've been working on the same project as he is, but we come from totally different backgrounds. So obviously I run One Step Removed. I'm a programming and algo company, and Batur's background is that he's worked at every major bank that you've heard of. Credit Suisse, Deutsche Bank, HSBC, and everything that he's done in those banks is he's done FX trading. So he's made markets, he takes positions for the bank, and the great thing about this month is I've learned a ton of what it actually is like to be in the center of the Forex world. And Batur has been telling me a lot about his experiences, and I thought it would be great for you guys watching to get a sense for how the big banks actually take their positions and what they actually do on a day-to-day basis. We've been having some good laughs. One of the systems we're trying to reverse engineer is from Forex Factory, and you see a lot of conspiracy theories about how all the big banks are out to get you and how they've got this obsession with getting the most out of every single person, and it's just not how it is. And I'm really technologically oriented, so my big view of the banks was that they're super sophisticated and they've got this great knowledge and information and scientific method for why they do things, and that's not the case either. And I've learned that.
Not really.
And I've learned that from talking to Batur for the last couple of months. So I just wanted to ask him a couple of questions to get a feel for what it's like, and then we'll go through it. I don't know exactly how long the video is going to last, but it'd probably be about 20 or 30 minutes. So Batur, thanks for agreeing to be on camera.
No problem.
So you started out working as a trader for a private client here in Turkey.
That's correct. I started managing money for one of the local billionaires and then moved on to a fund management house in Turkey. And then moved to HSBC, Credit Suisse and Deutsche in that order, managing FX positions and local currency bonds mostly. What I did was mostly emerging markets FX trading, but I have done some euro-dollar and I have done some Aussie as well.
Okay, so you just stumbled into working for a billionaire.
Well, it's kind of, we are from the same school, so that kind of helped. But they were basically looking for some young people who they could teach what they wanted to do with.
Okay.
We had this one guy who was an ex-Deutsche trader. He actually built the whole system up from the ground, so I was one of the recruited ones from the school.
Very nice. And when you got your experience in the banks and you started working, how do they actually train traders? Like when you're an institutional trader, what do they do to teach?
Well, most people think banks are very sophisticated and they have plans for everything. The reality is, especially the London investment banking, is actually not sophisticated at all. The people themselves are sophisticated. They come from good schools and strong backgrounds. However, the banks have invested very little money since the 80s and the 90s in infrastructure and software development. So most of the software is from 80s. Even Reuters today was made in 75, I think.
Okay. Reuters is probably one of the biggest FX platforms in the world, by the way.
The banks themselves don't really invest much into the people either because the turnover is very huge. They don't really know who's going to lead when. So basically you're pretty much alone with your instincts and your gut feelings. But there are ways to learn from the older generations. They are usually there to be a mentor, try to teach you stuff, but there is really no sophisticated way of raising a good trader from the ground up.
So you've talked a lot about the lifestyle and the pressures of working in London as a trader, and you just mentioned the high turnover. And you've also mentioned a lot of the star traders go to hedge funds. Is that all the turnover, or how many people wash out?
Well, basically, let's say 10 people start up this X investment bank in London at some point. If the product that you're dealing with is profitable, that meaning, look, for the last 5 years, let's say, bonds have been very profitable because of the low interest rate environment. Euro-dollar has been relatively profitable, but let's say CHF has not been profitable because it doesn't move much. It's not volatile enough. So if you're lucky enough to be in the right product market, then you have to be better than the 7 or 8 other traders, because basically in a bank most people think there's around 500 traders when they see the pictures of the large trading rooms, but the truth is most of those people are M&A people, equities, sales. In the largest FX bank, which is Deutsche, at the moment there is about 70 FX traders. So not that many, and every year a lot of people leave the school to become a trader. So at the end of the day, 10 people start into the first year, some of them have already left. At the end of 5 years, there is barely 1 or 2.
Okay.
Most of them, in a funny way, leave by themselves, because the pressure of trying to make money gets to you very fast if you don't really have the talent.
Right.
Yeah. So
imagine that.
Yeah, well, basically the bank takes you on as a fresh starter. What's different than most people would expect is they want you to start making money right away.
Okay.
In a small way, maybe with help from other people, but they really don't give you 6 months to get a hold of yourself and learn about the place or anything. So if you're lucky enough to have the guts to try this, and if you're lucky enough to get the right trades done at the right time, you might have a 6-month start.
Okay.
But I'm personally, I'm guessing there is more luck in play there than real knowledge, because first 6 months, if things go bad, sometimes it's just well done.
Okay. And I noticed that a lot of the positions that you talked about, not just for yourself, but for all bank traders really, is not this crazy intraday technical analysis with a mechanical system. It's the exact opposite of that.
The truth is, about while I was trading at the bank, I've seen very little technical analysis at all. The main reason for this is the bank is the market-making exchange. The bank is the place where the market is made when there is no prices in the market. So if you're the market maker, if you're the price maker, you can't look at historical data and make up a price for the events that are happening right now. If you have events happening today, like let's say Lehman Brothers in 2008, you need to have a real person sitting at that desk, not looking at the historical data, but looking at the customer flow, most importantly, and the events and what they understand from them translates into the price action in the day. One of the main reasons why a trader can't really trade intraday is because constantly you have customers taking prices from you. So you don't have the luxury of sitting down and like looking at charts and Fibonacci levels or stuff like that. Because average trading rate of a euro-dollar trader is about 10 to 15 deals a minute when it's really going.
Okay.
So he doesn't really have the time to look at things or anything, but if he's a good trader, he will have come in the morning. He will have prepared some scenarios with different outcomes in case a data might come in or whatever might happen. So he's going to be prepared for pretty much whatever might happen. And the difference basically is while these trades from the customers flow in, all he does is he buys at some predetermined level that he thought about in the morning. He usually doesn't even know the exact size because of the customer deals always flowing in.
Right.
You never actually know your position exactly,
okay,
because there is no software developed for this.
So you don't know whether you're net long 50 or 70?
No, not really. Because the average flow is anywhere from $50 to $250.
Okay.
Most pound and euro dollar traders carry positions around $200 to $300 worth.
And when you say dollars, that means million.
Yeah, $1 million, yeah. And that's basically only to cover the customer flows.
Okay.
So if he wants to put on a large position, it has to be around $500 million.
And I think that's a real key distinction that's probably going to go over most people's heads. So when we talk about trading, we're used to seeing the prices just flicking on the screen. They come from this magic box. And I always just thought that there was some super scientific algorithm designed by PhDs that's fluttering this across my screen. But that's not the case at all. It's really, the banks aren't taking positions, they're accepting positions. They're making a market.
That is true. There is an algo department in every bank, and they have made money in the last 5 to 10 years, but they're proving to be less and less profitable because the more algos there are out there in the market, the less profits there are to actually get. So yes, there are algo trading teams, but they have never been more profitable than a good FX trader. A manual trader has never been beaten so far. The largest P&L I've heard from an algo was around $5 million a year, I think.
Okay.
And that would, with $5 million, you wouldn't be able to keep your job as a manual trader.
Okay.
So it's a little different than what people think. But I would say the day traders who trade with the brokers mostly trade with algos. To be able to have access to a manual trader, you would have to have significant capital, more than $50 million definitely.
Okay, so that's just hedge funds and pretty good sized institutions.
Pretty much.
So when you're trading, that's just a totally different concept. And the one thing that tripped me up before was we talked about market making. I only trade when I think I have an advantage.
Yeah.
But when you're making a market, you don't get that luxury. Why can't you pick your own positions?
Well, let's say you're market making for euro dollar at Deutsche Bank.
Okay.
They have around $20 billion of flow a day.
Okay.
And you basically have to manage the larger sizes. So around $5 billion of this is going to have to be manually made.
Okay.
You're going to take a position at some point, obviously, and you're going to want to be long maybe 100 million euros. And then some other guy in a London hedge fund will come and sell you 500 euros, let's say, 500 million euros. While you're trying to sell that, some other hedge fund from France will come and they will buy 750 million euros.
Okay.
While you're actually serving these clients, you're getting a very important set of information actually. You're understanding what the European hedge funds, the European real money guys are doing, and what the London guys are doing. If you understand the market correctly, you will know why these guys are doing these things. But there's a cost to it, obviously. The cost is that you're giving them liquidity. So for you to hold on to your own position is very hard.
Right.
So the only way to keep your position is actually to predict what's going to happen. So if your dollar is going lower because of some euro negative market news, you have to be as much short as possible, pretty much, because the customer's flow, when it starts to flow in, it's not going to give you a break so you can put back your position on or think about it.
Right.
So people usually do whatever they can in the time they have, and then things fall into place in about 2 to 3 minutes. But the volatility in that region is crazy. And most people, when I read the chat rooms and the platforms and everything, most people think actually there are traders trying to target certain levels in euro dollar or anything else. Traders do trade at certain levels, but actually if you think about it, the levels are dictated by the customer. Okay. Because wherever you put your stops, the market goes to. If you put $1 million worth of stops, it's nothing. But if, let's say, 90% of the hedge funds in the world puts a stop loss at euro dollar at 100 pips from here, naturally a euro dollar trader would have to start buying before it hits that spot. Because after you hit the stop loss, it's too late to buy 700 euros.
Right.
So naturally, euro dollar trader starts to build up the position for that stop, because when he hits there, he doesn't want to lose money. So he doesn't actually try to stop people out, but to keep himself in a comfort zone that is actually understandable by his bosses.
Right.
He has to keep buying as the euro dollar approaches the stops. The only way to hedge is buying. Anyone who has traded options would understand this through the delta trading. If you have options and if you want to hedge it, as the price moves, you have to sell and buy to hedge your positions. It's exactly the same thing. So the closer you get to the order, the more of the order you have to close.
So for me, I used to work at one of the biggest FX brokerages in the world, and we had this cool tool when only like 5 people had access to it. But you could see the cloud of all the different stop levels on a meta level. So you knew that like 133, there were crazy concentration of stops. But you on the desk, you're the guy making the market. You don't have access to that information like on a computer screen, do you?
No, we didn't really have that kind of software. I'm not sure why, but the investment banks seem to have stopped developing software in the late 80s. Any software that's developed is mainly in-house, barely works. And emerging markets in investment banks, for example, have started in the last 10-15 years really. Most of the bonds pricing and most of the even options pricing still runs on Excel.
Okay, so that's just Microsoft Excel, same thing you get.
As crazy as that sounds, because of the complexity of the matters and because the products keep changing faster than the projects,
right?
It's impossible for an investment bank to actually come up with a software without actually shutting down business first.
Okay.
So they are not able to catch up with whatever's happening in the market, but it seems for the time being manual traders are able to trade this because they are still profitable. If we come to a point where algos take more of the market than they do now, I think they take around 60 to 70% of the market now. But if they become larger, then it could be problematic for manual traders. But the real advantage of a manual trader is you never get a ticket for $1 million or $2 million. Your tickets are 250, 500, or any size like that. So you don't get 100,000 tickets a day like algo does.
Right. Yeah, because if you should put through a ticket for 500 million on an electronic platform, it's just going to go nuts.
Probably.
Yeah.
Yeah.
So with the one thing that interests me is when we were talking about the stops, how do you actually know where the stops are? You don't have the software.
Well, basically, if you're smart enough, you will check them out in the morning.
So you have an order book that you can
there is an order book. It's not exactly very well organized, but this is how it works. There's a salesperson for every hedge fund and every real money fund. These people collect the orders. Okay. There's an order book where they put in all the orders, but these orders won't get executed automatically. It's not that developed.
Okay.
But as the market comes close to the order levels, this salesperson will get up and come closer to you. The closer the order is, the closer the salesperson. So they will remind you.
So something's up.
Yeah, basically.
So there's literally a guy that just hovers over your shoulder and says, "Buy me 50 euro."
Yeah, this is why the trading rooms are huge, really. The number of traders is not large at all.
Right.
In a place like Forex Bank, it's 5 people.
So you just have a bunch of vultures wanting to get their commissions, make sure that gets their bill.
Exactly, that's very well said.
Okay, and the other thing I wanted to ask you about is I know you made markets for emerging market currencies. How do you decide things like is there a spread in your head, or is it just I'll sell you lira for this much?
Well, there is a spread, but spread unfortunately is mostly decided by competition.
Okay.
The more banks do the same business, the tighter the spread. So when I started doing dollar Turkey and dollar rand, spreads were about 5 times what they are now.
Okay.
But at that point, only 5 banks traded in dollar Turkey. Now there are about 55 banks worldwide who trade in dollar Turkey, and the spreads have fallen to almost euro-dollar-like levels.
Right.
So I guess it's the market condition that really tells you what the spread might be. But the competition is so fierce these days, and banks really are having trouble keeping customers. Spreads are mostly decided by competition. Most of the time it doesn't make sense. Most of the time you lose money on the trades you do. This probably sounds very funny to most people outside banking because as far as I can see, everyone thinks the banks keep making money from every customer trade.
Right.
In FX, about 75% of the deals actually lose money.
Okay.
As soon as they trade, because they get very tight spreads from you.
Right.
Let's say in 750 euro dollar, it's very hard to get out of your position very fast.
Okay.
And what you make money from is not the deal itself, but the understanding of the market that comes with it. So if somebody buys $1 billion from you, the likelihood of you thinking that euro will go higher at the right time increases significantly. And if you have the larger size of trading positions, you can easily make up the money that you've just lost to the client.
Okay, so you're basically trading a small loss for the information of where you think the market will go.
Yeah.
So, and how are you doing that when you're making a market? Because you don't have control over the situation.
Well, you don't really have control over the situation, but you know fundamentally what might happen in the market.
Okay.
So if I think, let's say, these days emerging markets are trading very weak, so basically dollar Turkey, dollar rand, dollar max, everything is going higher. So you don't really need to be that smart to keep buy dollars at every dip. So when customers ask you for prices, basically what you do is you try to buy dollars as much as you can in the dips.
Okay.
And if some customers come and buy it from you, you pretty much replace it from the market.
So how do you get customers to buy it from you? Are you getting really aggressive about selling them dollars or buying them dollars? Or?
Well, you can't really do much. The trader only executes the trades and keeps track of the positions. You really don't have much time for anything else. Basically what happens is salespeople come over to you every morning.
Okay.
They take your ideas on the market and what might happen.
Okay.
If you have solid trade ideas, they take these ideas to their clients, which are hedge funds and real money guys.
Okay.
If these funds actually like the trade ideas, they will do this trade with you.
Okay.
And if you're smart enough to have the right trade idea, hopefully you put on the position. So when these guys come to trade with you, you can give them a tight spread. And when they buy the dollars from you, let's say you're trading in these days, you'll still have enough dollars to make money on your own.
Okay. And how does that work incentive-wise? Because if you as the trader, you're taking on the market risk from those clients, but you're also giving them the advice.
Well, it's the job of the trader to come up with a trading idea and make money from it. Basically, at the hedge funds, people are traders as well.
Right.
They're the better ones.
Why?
Well, when you first start the bank, you're basically getting paid 3 to 5% of your profits.
Okay.
So if you make $10 million for the bank, you take home about 5% of it before taxes. In a hedge fund, that's about 20%.
Okay.
So a guy who's been trading well in a bank for about 5 years, and well meaning exceptionally well, is recruited by hedge funds quite easily.
Okay.
In the first 10 years or so, most very good people are taken over by hedge funds.
So there's kind of a tier system. If you work for a hedge fund, you're probably like an all-star, but if you're
well, there's all kinds of hedge funds. I'm talking about the larger, better ones.
Sure.
But,
yeah, there's a lot of. I talk to people that are starting hedge funds, and they're not.
No, there are just too many hedge funds. I'm talking about the ones that are over a few $1 billion in assets under management.
Sure.
What else can I talk about? I don't know.
Well, the thing that I was wondering in the back of my head was when you say that you're actually on the phone talking to a guy and he buys 50 million euros. How does that, like you're on the phone, how does that trade get marked? Are you like scribbling on pieces of paper? Or?
Basically, we use other stuff called hoots.
Okay.
You don't need to use the phone the way you do. It's like a operator thing. You press a button,
okay,
and everyone kind of hears each other's conversation. The only downside to it is you can hear the guys next to you as well.
Okay.
Speaking to their customers and their salespeople.
So you can kind of, like, you're actually in the room physically hearing the prices that are trading and who's buying and who's selling. And you know the traders, like that guy's not as good as that guy.
Yeah, pretty much everything. After a while, like people who walk into a trading room, first they think it's just a crowded place with a lot of noise, but in a while you start to be able to tell people apart. You're even able to tell the people's trades apart. When they make a trade that makes money, you can tell from their voices.
Right.
So the more time you spend in there, the better it becomes. But it's pretty much like a conference call kind of environment.
Okay.
But the thing is, everyone is speaking at the same time. It's a bit of a challenge, but brokers have been doing this for years, and they're almost perfect at it.
So how do you cope? Because now you're working here in Istanbul and managing money for a private client, and you don't have that stimulation, that feedback.
It's quite different, I have to say. I haven't been trading like I used to in terms of performance, but this was totally expected because most of my friends who've been to hedge funds and money management firms have this problem. One of the main problems is, as a trader, you always have your own ideas, but there are other traders around you who can pretty much call you out if you're doing something really stupid.
Okay.
That kind of gives you some kind of security.
Right.
Trading alone in a room, which most people out in the market do, is quite different from that. Actually seeing a euro-dollar trader making or losing money next to you gives you a lot, tells you a lot about the market situation right now, and it makes trading in emerging markets much easier. So I have a lot of respect for the guys who sit at home and try to trade it through. I'm trying to learn it, but it's not very easy at all.
I totally agree. With algorithms, we talked a little bit in the last couple of weeks about how when the prices are streaming across the screen, you mentioned that it is algorithmically driven, but there's still a human decision in it. And you told me something about there's one really important guy in the bank that decides that the euro dollar is going to 131 today, and then they do something with the algorithm and stuff happens. Can you explain more about that?
Well, we built up the algo platform for emerging markets FX, and that's where I got most of my experience, but I've never run it. But the way I see it is you have to have a fundamental idea of where the currencies are going. Algorithms are very good at range trading or maybe even breakouts, but they can't really tell you anything from the news flow or the fundamental information. So basically you need a very experienced trader to tell the algo, well, not tell the algo maybe, but to help the algo get a bias.
Okay.
After the algo gets that bias, it can trade around it. So basically in an algo team what you have is a strategist who's probably a 20-something-year-old trader. But
20 years of experience?
20 years of experience.
Yeah, not 20.
No, not 20 years old. Who's not trading in the daily market anymore,
okay,
but maybe writing strategy pieces. And then there's a bunch of PhDs basically trying to set up the algo. The thing about the algos is they evolve on a daily basis, so it's never done. These guys are always working on something, trying to adjust to the market conditions at the time. But basically the strategist makes out a call, if he thinks the dollar is going to gain ground against the euro, he makes this call, and he makes another call in terms of volatility. He might say it's going to take a while, so whatever algo you're building, it should be a trending lower type of algo. And then the mathematicians get into it and try to derive something that actually makes money. Or if it's a case like 2008, the strategist might just come up with the idea of shutting down the algo.
Okay.
This has happened before.
Okay.
The point of algo trading is not to be in a position at any given time. Most of the time algos are in a position.
Right.
All the time in the day. But in cases like 2008 where volatility is unpredictable, sometimes the best option is just to turn it off.
Okay, so you're making a market. What happens? If you're the big strategist and you decide, okay, let's shut the algo off, the bank can't just stop making a market. You're going to have an angry floor of salespeople. So
that
what
is
do you do?
true. Manual trading takes more of the weight in that case. The algo is never 100% shut down, but there's a lot of different things you can play around with. You can play around with the spreads you give out from the algo that restricts customer trading up to a point.
So there's a big red button that says big spread or something like that?
There is actually.
Is it really?
There's a panic button that widens the spreads, and it's quite useful. I've used it quite a time. You can make the price feed faster than it is right now. In an algo, the most desirable thing for a hedge fund customer is the pace of the price feed. They don't want the price to change every millisecond, because it makes it very hard for them to trade. But if the volatility is going high, you just have to make it trade at a much faster pace. That's one of the solutions. The basic main solution is to give the responsibility to a manual trader at the end of the day, because algos break down at times of unpredicted events.
Right. So you guys are kind of like on the floor, and you're like the crisis team. The algo does the routine donkey work, and you guys handle the...
Basically, you still need a human being to be able to tell the difference between hell and just a glitch.
Okay.
One day maybe it will come to a point where algos can do this, but I don't think that day is just around the corner yet.
So we've spent practically the last month trying to come up with a strategy that's based on our clients' manual discretionary trades. What's your general impression of the strategy development process and the challenges?
Well, I think the main thing is not forgetting that you're never going to be able to get out of this algo. The manual trader always has to stay inside every trade, pretty much. It's not going to be a robot that runs by itself and makes money for you. It's just, life just doesn't work that way. So algo doesn't work that way. I'm not disappointed in that sense at all if I can't come up with an algo, but I think if you know what you're doing, if you know what to expect, and if you're ready to spend the time with the algo during development and during trading as well, I think there's a lot of opportunities for high frequency trading.
Okay.
I wouldn't say an algo is the best way to trade a trend, because most of the stuff that I've seen in the chat rooms and the posts, stuff that we've looked over, human being still is better at telling trends, because the algo is looking at backward data. It's trying to interpolate things, lines between 2 points in a very non-human way.
Right.
But still, I think human beings are better at riding the trend and buying into positions that are making money, etc. But the algo is very good at high-frequency intraday trading, which could be a range trading environment for 6 hours, which could be a range trading environment for 6 days. I think the real catch here is, of course, coming up with the algo is very difficult, but the catch is also coming up with the right environment for this algo.
Sure.
So what I've learned is you can come up with the algo, but you can never leave the algo alone. It's like a child.
So the idea of like coming up with your algorithm and just moving to Costa Rica and letting your black box make you money
just doesn't seem to be happening today.
And with it's interesting you mentioned the range trade, because one of the things that we experienced during this last month is we're trying to develop a trend trading strategy, and I would constantly watch it fall apart, and I kept saying, this is going to be a great range trading strategy. If only we would stop this trending approach and we go to a range. Look what happens when we run these backtest results.
Well, if you think about it, an algo basically runs on mathematical equations. How interesting these equations might be actually does not change anything. It relies on historical data.
Right.
It might be very complicated in terms of formulation, but still it will depend on backward data. How a trend starts is most of the time, fundamental reasons start a trend. And if it's going to keep going on, the fundamental reasons stay there most of the time. This is a very logical way of trading. It has very little to do with the backward data.
Right.
But in case of a range trading environment, the backward data is actually very applicable because there is no fundamental reason for a range trade. An algo does wonders in a range trade. There is nothing to understand. So
trade the chop.
Trade the chop, exactly. But if you have an idea that you think is going to start into a trend, I think a human being has to do it. We have been trying to build an algo, but what we've been doing pretty much is we have a certain discipline of getting into a trade. Every trader has a certain discipline of getting into a trade. But I think personalities are very different between people. So everyone's personality actually enjoys a different kind of entry to a trade.
Right.
Some people might like larger stops. They would not be bothered by the drawdowns. Some people don't like drawdowns, but they like to add on to winning positions. Maybe if a trend is going over, they add on higher lows. In any case, I think it's a very personal thing. So I don't expect an algo to come up with an idea that would fit every person.
Right.
If I was trying to develop an algo, I would probably develop a set of rules, a discipline in trading, and then I would familiarize myself with the rules, and then I would come up with an algo that runs in mostly range trading environments.
Okay, so you're going to use your human discretion to apply a gray box strategy. Maybe that runs for, what, a couple weeks, couple months, something to that effect?
I think a great example would be Euro-CHF. After the central bank intervened in Euro-CHF, there was about 6 months of doing nothing but a small bad range. But everyone was expecting it to break at some point.
Yeah, myself included. Yeah. I was waiting for that bomb to go off.
You have two choices in this kind of environment. What I had done back in the day was take a position for a break and wait for 6 months, which doesn't work very well.
No.
But if you run your algo for a considerable amount of time, you will make some money. And as soon as your algo starts losing money, you'll understand the trend is starting. I think a perfect example and a very good use of the algo is such situations where you know it's going to trend for a while. Use the algo. As soon as it stops making money, use your mind, come up with a fundamental reason why your algo has not been making money in the last few trades. And if you understand everything correctly, you will be able to ride the trend that's coming.
So you can use algorithms more to define the context and give you some feedback. Because what I've noticed with trading is it's such an open-ended problem. Like you buy and then you have a 50-50 shot at making money. And getting the feedback of, well, did I make money because I'm good? Or did I make money because I got lucky? So, yeah, I mean, a lot of people have trouble actually learning, am I doing something right? Am I on just a lucky streak? Am I on a bad streak? But by doing things like setting algorithms to define context, it gives you a defined problem, so you start to analyze why it's behaving a certain way.
That's very true. Unfortunately, most people, due to psychological reasons, they tend to overestimate themselves. The more money you make, the more you overestimate yourself, and it is the same for everyone.
Sure.
Algo kind of gets in front of that and hopefully helps you handle the situation a little more logically.
Okay, awesome. And you want to tell everybody about the newsletter that you're starting?
Well, I have started a new website, Windows Capital. It's going to come online in a few days, where I will provide people with market information. The main difference from the platforms right now would be I will use the same kind of stuff that I will be sending to hedge funds in a bank environment. I will actually send trade ideas out, and when they don't work out, I will send out fundamental reasons, which I think the industry is lacking right now. There's so many traders out there who trade through platforms that go through smaller brokerage companies. They actually have great opportunities to talk to each other, which they do, but they don't really get the fundamental support from anyone like banks.
Right.
Because I guess mainly the reason is the individual customer is too small for a bank to cater to. But I guess my website will be helpful in that sense to guide people somewhat in fundamental ways of the markets. Even if my views are wrong, that could be used as a trade idea as well.
Sure.
As long as you take a view, I think it's helpful.
Awesome. Well, thanks for joining us today, and thank you guys for listening. Again, my name is Sean Overton, and the website is www.onestepremove.com.